Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Broadcom stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or sell. Broadcom is a designer, developer, manufacturer, and global supplier of a wide range of semiconductor and infrastructure software products. The company is headquartered in San Jose, California, and was founded in 1961. It went public in 2009 and currently trades on the NASDAQ. Its product offerings serve the data center, networking, software, broadband, wireless, and storage industrial markets. It was originally started as a semiconductor products division of Hewlett-Packard. Let's get started with the model. This is a large cap company. 197 billion market cap. They're trading at $4.83 a share, and they have 408 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has a lot of free cash flow, from $8 billion up to $12 billion a year. That's a ton of cash to work with. Net income is the profit and loss on the income statement. It's revenue minus expenses. That was over $12 billion in 2018. It dropped to $2.7 billion in 2019, then grew to nearly $4 billion in the trailing 12 months. Revenue is a sales for the company, and that grows each year from 21 billion to 25 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. The difference is the gross profit, and they had their highest gross profit in the trailing 12 months at 14.2 billion, much higher than 2018 of 10.7 billion. Below that is operating expenses. Examples are marketing and depreciation. Then below that is operating income. And that was the highest in 2018. It was a little lower in the trailing 12 months. Much higher than in 2020 though. Below that is the interest income of 53 million. And then the interest they pay in their debt, which is 1.9 billion. That's a little more than 2020. And it's more than triple 2018's interest expense. Below that is other income and expenses. This is usually impairments and write-offs. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income. It looks really odd because they don't pay taxes. They get a tax refund every year. Their net income is higher than their pre-tax income every year. In 2018, they had an $8 billion tax rebate. That's why their net income was so high. I would focus on operating income when I look at the income statement. They were receiving really large tax rebates from the Singapore Economic Development Board because of their large presence in Singapore. But those large tax breaks are going to expire at the end of this year. So their net income won't be as inflated as it is in prior years. And this is from their annual report. It mentions their tax rebates from the way the company recognizes taxes. Also an excess benefit from stock-based compensation. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. And then you have capital expenditures, which are investments in property, plant, and equipment. That's around $500 million every year. It was the highest in 2018 at 600 million. Operating cash flow minus capex gives you your free cash flow. And this company has a ton of free cash flow to work with. They do pay a nice dividend, but another way to reward shareholders is to buy back stock. They bought back 7 billion in 2018, 6 billion in 2019, 700 million in 2020, and 800 million in the trailing 12 months. When a company buys back stock, it decreases the shares outstanding, making your shares more valuable. They also issued a lot of debt in 2019 and 2020. They issued $30 billion of debt in 2019 and paid off $17 billion. So they added $13 billion of debt that year. They added about $8 billion of debt in 2020. When a company has positive free cash flow and they add a lot of debt, that's mainly because they're acquiring another business. Or it can be to fund their dividend payment, but they have enough free cash flow to fund their dividend. Their dividend is currently $5.5 billion a year. Let's look at the capital structure. $24 billion of equity, $42 billion of debt. They're 36% equity, 64% debt. Their net debt is $32 billion, and their WACC is 9%. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's $223 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $200 billion. We divide that by 408 million shares. And we get a calculated stock price of $4.90. They're trading at $4.83, so they're trading at a 2% discount. It's a really small buy according to the model. Simply Wall Street is at $5.56, so they're saying the stock is 12% undervalued. 22 analysts priced this stock over the past 3 months. The average price target was $5.20. The low was $4.40, the high was $5.80. My valuation is in the middle, but a little closer to the low than the high. This is a stock price the last 5 years, so you can see the stock has only gone up. You could have bought it pretty much anywhere and you could have made money as long as you held for at least a month or two. The company has been raising their dividend a lot. It was 50 cents back in 2016. Now it's up to $3.60. They pay a 3% dividend, and their payout ratio is 149%. But I like to look at the dividend payment over free cash flow. That's at 47%. I like to follow the cash, because remember what I said earlier, net income is accounting profit and loss. So the income statement is manipulated using accounting tricks, where free cash flow, there's much less manipulation. The top 25% of the market pays a 3.5% dividend. They're a little lower than the top 25% at 2.9%. The industry average is 1.3%, so they're much better than their industry. And the company has a beta of 1, so the stock moves with the market. The stock has gone up 93% in the past 52 weeks, while the S&P 500 went up 53%. The 52-week low was 247, the high was 495, and the stock is trading above its 200-day and 50-day moving average. About 2.5 million shares are traded each day on this stock. Of the 408 million shares outstanding, 401 million are on float, 82% are held by institutions, and about 1.5% of the shares are shorted. In the past year, this stock has improved 100%. While its industry improved 96% and the market 65%. If you look in the past 5 years, this stock has improved 265%, which is a lot, but its industry did much better, improving 348%, while the market only improved 124%. Semiconductors have done really well the past 5 years, as you can tell. Analysts are forecasting their earnings to grow 24%, while its industry grows 16% and the market grows 19%. Revenue forecast for this company is to grow 5%, the industry 8%, and the market 10%. In the past 5 years, their annual earnings grew 21%, while its industry grew 14% and the market grew 12%. In the past year, this company's earnings grew 45%, the industry 30%, and the market only 3%. If you invested $10,000 into this company 10 years ago, you'd be at $190,000 today. That's an annual return of 34%. The biggest shareholder is Capital Research at 26%, then Vanguard, BlackRock, State Street, and the last on this list is Columbia Management at 1.5%. Let's look at the financial ratios. The average PE in the market is 32, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 50, so investors are paying $50 for $1 of earnings. Price to sales is stock price over sales per share. They're 8.0. Price to book is stock price over book value per share. They're at 8.2. And the way you calculate book value per share, it's equity over shares outstanding. equity is assets minus liabilities on the balance sheet, and they have $24 billion of equity, negative $35 billion of tangible equity, since they have nearly $60 billion of intangible assets on their balance sheet. Intangible assets come about when you acquire another business. So obviously they're acquiring a lot of businesses to grow and expand. Their return on invested capital is 9.5%, and their WACC is 9%, which is only a 0.5% excess return. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments almost 3 times. ROE is net income over equity. They have a great ROE at 16%. Current ratio is current assets over current liabilities. They can cover their current liabilities 2 times. And their current assets are $9.5 billion of cash and $2.5 billion of receivables. The company does seem to be well capitalized. They had over $12 billion of free cash flow, $7.5 billion of working capital, and a little under $6 billion dividend payment. So they have $14 billion of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 12 semiconductor companies, and Broadcom is right here. If they have a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're worse in price to earnings and price to sales. They're a little better in price to book. Their current ratio is fine. They're a little lower in ROE than the average, a lot higher in debt than the average, and they're a really big company, 197 billion market cap. That's definitely bigger than the average. And they pay a nice dividend of 3%, much bigger than the average. So to summarize, I have them trading at a 2% discount. This is a really great company. It's big, it's stable, it's been around a long time. For a long-term investment, I think it's great. In the short term, anything can happen. The stock price can fluctuate, although it seems like it's going up and up. But they don't have a great PE, but that doesn't mean the stock price can't go up. I rank their free cash flows 9 out of 10, their revenue 8 out of 10, and their ratio is 4 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.